The cheapest loans aren't given to the highest earners, they're given to the most predictable borrowers. Banks don't just look at your credit score in a snapshot. They study patterns. And a few quiet credit habits, practiced consistently, can lower your borrowing costs for decades, without you ever negotiating a single rate. In this video, we're breaking down 3 credit habits that silently reduce interest, unlock better approvals, and save you tens of thousands over a lifetime. Before we get started, if you want credit working for you in the background instead of against you, hit subscribe. This is where the system gets explained. 3. They keep their credit usage under 30%. This is known as your credit utilization ratio, and it's one of the most important factors in your credit score. It essentially measures how much of your available credit you're using at any given time. Lenders look at this number closely because it tells them how responsible you are with borrowing. Here's how it works in practice. Suppose you have a credit card with a $10,000 limit. If you keep your balance below $3,000, that's a utilization of 30% or less, which signals to lenders that you're managing your credit wisely. Once you go above that 30% threshold, your score can start dropping rapidly. High utilization suggests that you might be financially stretched, even if you pay off your bills on time. People with excellent credit know this rule inside and out and follow it consistently. They avoid maxing out cards, even if they have the means to pay the balance off. They might spread purchases across multiple cards to keep each one's utilization low. Some take it a step further by paying down balances multiple times each month, so the amount reported to credit bureaus is minimal. Why does this matter so much? Because high utilization can end up costing you a fortune. When you apply for a mortgage, car loan, or any major credit, lenders may view high usage as a risk factor. That elevated risk can translate to higher interest rates. For example, the difference between a 3.5% mortgage and a 4.5% mortgage on a $300,000 home is over $60,000 in extra interest over 30 years. All because of a simple percentage you could have managed. Savvy credit users treat their credit limit like a boundary they never cross. They keep balances low, pay frequently, and avoid unnecessary financial stress. By managing utilization carefully, they gain access to lower rates, better loan terms, and long-term financial advantages that last a lifetime. Small actions like this compound over time, creating massive savings and stronger credit health. 2. They never miss a payment ever. Payment history is by far the most important factor in your credit score, accounting for roughly 35% of the total calculation. That means more than a third of what determines your creditworthiness comes down to whether you pay your bills on time. And it's not something to take lightly. One missed payment can linger on your record for up to 7 years. Even a single late payment can knock 100 points or more off your score, depending on your overall credit profile. People who maintain exceptional credit treat every payment as if it's the most important bill in their life. They don't rely on memory alone. They set up automatic payments, schedule calendar reminders, and check their accounts regularly to make sure nothing slips through the cracks. In their world, missing a payment simply isn't an option. It's not just about avoiding a temporary dip in your score. It's about protecting your long-term financial reputation. Here's something many people don't realize. A missed payment creates a permanent record that lenders can see when evaluating you. Even if your credit score recovers over time, that late payment remains on your history. Lenders notice it. It raises questions about your reliability and risk level. When you're competing for the best interest rates or loan terms, you're up against people with flawless payment histories. Why would a lender offer you the lowest rate if someone else has never missed a payment in their life? The benefits go beyond just your credit score. Consistently paying on time builds a habit of financial responsibility. You begin prioritizing obligations, managing cash flow effectively, and avoiding the stress of scrambling at the last minute to cover bills. That discipline naturally spills over into other areas of your financial life. The person who never misses a payment is often the same person who saves diligently, invests consistently, and steadily builds wealth over time. In essence, paying your bills on time isn't just a credit requirement. It's a foundational habit that reinforces every other positive financial behavior. One small action, repeated consistently, compounds over time to create stability, opportunity, and long-term financial success. 1. They maintain old credit accounts forever. The length of your credit history matters far more than most people realize, and it plays a major role in how lenders judge you. In fact, it makes up roughly 15% of your credit score. That may not sound huge at first, but when you're trying to qualify for a loan, a mortgage, or a low interest rate, that 15% can be the difference between approved and denied, or between a great rate and an expensive one. Lenders aren't just looking at whether you pay your bills on time today. They want proof that you've been responsible with credit over a long period of time. A long, stable credit history tells them you're predictable, disciplined, and low risk. The longer you successfully manage credit, the more confidence lenders have in you. This is where many people make a costly mistake. They close old credit cards because they don't use them anymore, or because they think fewer accounts looks better. In reality, closing old accounts erases valuable history. When an old account disappears, your average account age drops, and your credit score often drops with it. You're basically deleting proof of good behavior that took years to build. People with excellent credit almost never close their oldest cards. Even if the card is rarely used, they keep it open and active in simple ways. They might put a small recurring charge on it, like a streaming service or a phone bill, and set up automatic payments so it's paid off every month. Then they forget about it. The card quietly ages in the background, getting more valuable over time. That credit card you opened in college is not useless. It's a major asset. That store card you opened 10 years ago and never think about anymore. That's part of your credit foundation. Every month, those accounts stay open adds another positive data point to your history. Every year they age makes you look more trustworthy to lenders. Savvy credit users follow a simple long-term strategy. They open credit accounts early, use them responsibly, and keep them for life. The card might sit in a drawer, but it's working for them every single month. When they apply for a mortgage at age 35, they don't have 5 years of credit history. They have 15 or more. That difference can unlock better loan terms, lower interest rates, and far more financial options. Closing accounts also impacts another critical factor, your credit utilization ratio. This is the percentage of your available credit that you're using. If you have 3 cards with a total limit of $30,000 and you close one with a $10,000 limit, you instantly lose a third of your available credit. If your spending doesn't change, your utilization jumps higher, and higher utilization usually means a lower credit score. Good credit doesn't shout, it compounds. These habits don't feel powerful day to day, but over time, they quietly tilt the system in your favor. Once they're in place, borrowing becomes easier, cheaper, and far less stressful. If this shifted how you think about credit, like, subscribe, and share it with someone who plans to borrow more than once in their life.